Welcome back to Show O. Peng.guo and I are excited to be here this week. We've got a lot of interesting topics this week. So for first, we want to talk about China policy. And in actuality, we're doing a little bit of the inverse, US policy. So Executive Order 14032, which the Biden administration implemented recently, is actually an extension from a previous executive order. And this executive order is highlighting 59 Chinese companies that are banned from investment by US institutions and individuals. So what is that really going to mean? Well, it turns out a lot. There's currently 3 trillion renminbi invested from foreigners into the A-share market. 3 trillion renminbi, which is roughly half a trillion US dollars. So not all of that is US investors, but a big chunk of that is. For example, there are 50 different QFII holders that are US entities of the 300 total. So you have a lot of QFII holders, and of course, you have a lot of ETFs. So looking at this list of 59 names, it turns out 10 of them are in the CSI 300, which is the major market index in China. So I looked at which of these names are actually in one of the largest ETFs, which is ASHR. And it turns out they are. So I called the portfolio manager from ASHR, and he was polite enough to tell me that the deadline for compliance is August 2nd. And by August 2nd, barring any changes, all of those names are going to be out of the portfolio. It turns out those 10 names represent about 2.5% of the CSI 300. So the question is, will everybody comply? Will there be a change? It'll be an interesting space to watch in the next few weeks.
In my understanding, anything related to the compliance is almost in the top priority. Yeah, those names is a pretty big name. So we already see TikTok and WeChat is already lifted the constraint to use it. And I don't know is any change for those companies in the future or not.
Yeah, that's actually a good point. Yeah, no, stay on that point, that TikTok and WeChat, because although it's been reversed, there's still a CFIUS investigation going on. And also the executive order did call for the Commerce Department to conduct a greater review on those companies owned, controlled, or managed by persons that support foreign advising to the military or to international actions that were involved in malicious cyber activities. You know, there's a long dialogue about the executive order, but I don't think this is, I think this is more of the beginning, closer to the beginning than closer to the end of what's going to happen.
That's right. So I think the market already expect that this is probably a long-term United States and China political conflicts. But from the market, for all the most of the investors, they're probably more focused on the sector. And so as long as the sector weight is consistent with the benchmark, most of the time they should be fine.
Yeah, I think that the only thing we, you know, as boring as it may seem, the introduction of basis risk is going to be real though, because the CSI 300 is not going to change their index. So if you have a fund that tries to mimic or match the CSI 300 and you can't invest in these 10 companies, that's going to introduce definitely some basis risk.
Yeah, like China, for example, mutual fund companies, they have the constraint on the individual weight, like about 10% for the individual stock. So if more than the weight, obviously, you cannot exactly track the index. That is okay to make some adjustment.
Yeah, yeah. I think the other issue I wanted to bring up was China just signed an anti-foreign sanctions law. This is basically a hit back from laws that were passed in the EU and the US to go after Chinese individuals and corporations abroad conducting nefarious activities in Europe and the US. So this new law is the ratcheting up, if you will, of sanctions and potential liabilities that US and European individuals and corporations face on the ground in China.
No matter what happened, the bottom line is added a lot of the volatility and unpredicted risk for the business operations. No matter the process, investment process, and most of the time you will see it changes quickly. So it's not consistent. It could be overwrite during the night. So you never know what happened. If you follow this one, you get a screw up, most likely. Yeah, so, but I think another might be a good example. So like the Tesla. So we know this Tesla Model 3, right now this move to the Model Y. Model Y's profit margin is higher than the Model 3. Why? That because they use the big die casting machine. So this big machine, its weight is almost 410 tons. So this big animals successfully reduce the Tesla's cost. So, but if you spend some time to look behind it, who's a supplier for this big machine? That is called LK Technologies in China. So their shares is in the Hong Kong market. From the weekly chart, you will see the stock price get soared during the past of years. So I think from the investment perspective, we need to spend the time to help the client to get the better return, find the better stock, as well as the supply chain and find the related companies in this chain. So you will get the unexpected profit. It almost increased 20 times for the stock price.
Yeah, I think that's a great point. You know, we talked last week about where a stock lists is becoming less and less important, despite all of the headlines of executive orders and banning stocks and trading, which is not going to be allowed. You look at the news also, DD just announced they're going to go public in the US. So again, there's a very nuanced discussion to have about individual names, policy, compliance, and regulations. So we just wanted our viewers to be aware of some of the things that are going on, some of the timing, and a little bit of the calendar about this executive order. And with that,
just follow the truth and do the right things.
Yeah, that's it. We're gonna rename this this video channel. Follow the truth and do the right thing.
Okay. That's true.
Today on Capital Markets, we wanted to turn our attention to the private fund managers in China. And when we're talking about the private fund managers in China, we're thinking more like hedge funds, not private equity, but hedge funds. These are funds that invest in stocks and bonds traditionally, but also into the commodities market, which is something we've touched on in the past. And we wanted to give you a sense of the size and scope. So as of April, there were about 25,000 private fund managers, which is a massive number. And the number of individual funds is 105,000. So there's tons of funds. As we started this show, peng.guo and I said, China doesn't have a product problem. There's plenty of products out there. They do have an information gap for US investors. So 105,000 products, and the AUM in all of those products is about 17.75 trillion. So the average fund size is about 170 million renminbi, or about 25 million US dollar. Now, at 25 million US dollar, you are losing money. But the average, like in the US, is really skewed because there are a few managers that manage multiple billions. Like in the US, Bridgewater manages, I don't know, $160 billion. And then there are many, many smaller funds that are trying to catch up. So the reason I wanted to bring this up this week was A, the size of the market, B, it's been around for more than a decade, and C, there is some outsized performance. Now, it's hard to know who's going to outperform a priori, but we do see there are some massive outperformance, and they're really just placing heavy bets. And if they win, then AUM spikes and fees go up.
China private fund market is really started from zero and to such big size. It's amazing. So I think first things I would like to say, it's good news. As I know, like in Shenzhen, some of the friends, if they performance very well, the strategy is stable. They can build like the 10 billion renminbi during the 2 or 3 years. So it's pretty quick.
Yeah.
And another thing, like you said, there's so many products in the market. Marketing is pretty challenging. So most of the marketing came from the seed client. And a good thing is that China has so many individual clients. As long as you spend some time, you can survive it. But it's hard to grow up. That is the most difficult part for the private fund, because there's so many products in the market. It's hard to build a brand and stand out.
Right. I know there's a lot of foreign names that are entering in. You know, I mentioned Bridgewater. Bridgewater has a fund there. Two Sigma has a fund. A number of these high-profile names are trying to raise money in China, and it would be naive for us to sit here and think that the existing market isn't competitive. With 105,000 products, there are bound to be some that are outperformance. It's just an act of randomness as well. I did want to touch on the asset classes that are involved. So it's not just a long-only strategy or a leverage strategy. There's obviously a long-short strategy. There's market neutral. There's bond neutral. There's macro, event-driven. And we'll put up a chart of the monthly performance of each of these strategies over the last year, so viewers can take a look at what has worked, how big, how small. But one thing that we keep coming back to is lots of volatility. And you can see when the market sold off last year, it really sold off much harder in these private funds. And that's a result of leverage. A lot of these managers are taking on a lot of leverage.
In my understanding, from private fund perspective, leverage absolutely is not an easy thing. That really means the fund manager, whoever the shareholder of the company, take the risk. All the product right now is really based on their own performance. So it's a pretty fair market to test the fund manager's ability.
Yeah. One other point we wanted to mention is, for foreign investors, access to these funds is pretty difficult. There's no easy way to get in, because these are private funds. They generally can't take retail investors. They are not approved for QFII investment or RQFII or Stock Connect. But we wanted to bring it to the attention of our viewers because it is a big market, and these fund managers do provide liquidity. They provide market efficiency, and because they're generally trading a lot, they are in the market into a lot of names that are not on the run names as well. So that's why you see a lot of volatility.
Yeah,
you see some names go up. Yep.
Yeah, I think that's right. The volatility is pretty high, and at the same time, liquidity is pretty good, much better than other market. So that is why I'm keep saying China market is high efficient right now. So in such a high efficient market, index investment is pretty good. I think that really means that you can not just simply buy and hold index. It's more like the get the uptrend of the index. So you are enjoying the uptrend of the volatility to doing that. Fund selection is absolutely tough. So it's very hard to monitor active manager with active strategies in a dynamic market, or otherwise another easy solutions, just index investment or index portfolios to doing that.
Right. The other point is, a lot of these managers would not pass a strict due diligence, because it's a very different type of market. They don't have a long track record. Maybe they managed a fund at one of the large asset managers, and then they just flip that performance into their new company. And the winners of this year may not be the winners from last year, and the winners of this year won't be the winners from
last year.
So it's very difficult to pick a manager. Just as it's hard to pick stocks, it's also hard to pick a manager. So I think we're going to leave it there this week. Thanks for tuning in. Remember to subscribe, drop us a note, reach out. We're easy to find. Thanks again.
Thank you.